Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Hey, welcome to News You Can Use. I'm glad that you joined us today. We're continuing a conversation about, of course, coronavirus and the impact that coronavirus has on you and on me, on all of us, not only at home, but also obviously within the context of the industries that we're in. So we wanted to be a source, as we always hope to be, of both inspiration. And I love that song that was just playing. I hope you were here with us to hear it, The Rising by Bruce Springsteen. You ought to listen to it yourself sometime if you haven't heard it. It's an amazing song, particularly in a moment like this. I've had that song in my life at times in the past when I've needed inspiration to get out of a ditch, if you will. This is a pretty big ditch that we got ourselves in. We're trying everything. I mean, everything, aren't we, to solve this problem? The Fed has tried everything, and the federal government's trying everything, and the president is trying everything as well, including some things that maybe we ought not try. And I thought we'd try something a little bit different here on a news show, and that would be to go to times past and to go to a place where I think maybe many of us can at least just quiet ourselves and join me in prayer. I want y'all to know I'm fully respectful. I know we have a diverse audience. I know we have people that are not faith in their background as their number one priority. It is for me. For those that don't share the same belief, please understand our love for you. Ours, that is our company's for you, mine for you, no matter what. And just know that maybe in the next minute or so, as I pray, prior to giving you all a lot of information with regard to what's happening, that you just think about the things that you are still grateful for in your life, particularly the people, as they're the most important things that are in our lives. And for those that do pray, I want to use a piece of scripture. It says, "For where two or three gather in my name, there am I with them." It's very, very comforting for me always to know that when we come together, more than one of us, and we call on his name, he's going to be there with us. And it might be by Zoom, but we are still gathering. And so God is still with us. We've got a technical confirmation on that from my very good friend and pastor, Dr. Ike. So let's pray for those that do pray together. Join me. Heavenly Father, we're grateful we get to bow our heads. We're grateful that you tell us that you'll be there when we call on your name, and we're there now. And we don't want to come as pagans just asking for you to fix things. We want you to know that we trust you completely with every part of our lives, including with coronavirus. I just ask that for those that are here today, still gainfully employed, that they fully appreciate. For those that are here today that have relationships that are important to them, I just ask that you encourage them, both in terms of being generous because they're still employed with those that are not, those that are in need, both in their family and then otherwise their neighbors. And for those that have relationships, Father God, all of us, that we would use this time to strengthen those relationships, that we would lean in more than we ever have before. And we ask that you do help us find our way out of this, and that we bring out of it better. That is, that all of us get better as a result of having gone through it. We offer these prayers in your son, Jesus' name. Amen. Thank you respectfully for those folks that, again, don't share in the same belief, for giving me the opportunity to be able to express mine. Let's take the next step. Relationships, I just mentioned a moment ago, are the most important part of life. And they're really important, especially right now that you're doing well in relationships, right? Because you're spending a lot more time than ever at home with people that are the most important people in your life. And you've made decisions about that because they live with you, right? So the fact of the matter is that we all really need to be using this time to lean in and get even better at relationships. And a little bit of the call to all of us that we started this program with a couple of about 4 or 5 weeks ago was this idea of road to recovery and restoration being a part of it. And I just want all of you to know that whether you're a Democrat or you're a Republican, whether you believe we should reopen or not, whether you wear, a mask or not, I think the thing is that the call that was made to all of us by God was to love our neighbor. And it wasn't love our neighbor if they believe all the same things you believe. Love thy neighbor if they're the same political party or if they believe the same things about coronavirus. It was simply to love. So I just want to, in the reminder to all of us about how relationships work best, first you decide that you're going to love. It is a choice that we make. Then you make sacrifices, serving other people, putting their needs in front of your own. You'll have to be a forgiving type because things don't always go exactly right. And then you'll have hope in the future that tomorrow can be even better. And we'll take that with us, not only in our relationships, but we'll take it with us as we now start the conversation about the road to recovery. First of all, get ready. Buckle up, because the next couple of weeks, as we heard about 5 weeks ago, with regard to corona virus itself, that we were going to get the worst of the news, which we certainly have gotten a lot of difficult news. It's happening now in the economic side of things. We self-induced a coma. It was a self-induced economic coma in this country. We decided somewhere around March 17th that we were going to need to take drastic, unprecedented action to address coronavirus and flatten the curve of cases so that we would not overrun our medical industry in terms of their ability to provide services for those that are sick from coronavirus. But in doing that, that is, in that flattening, we had to make another choice. And that other choice was, for the first time, an unbelievably unprecedented idea, which would actually be to turn off the economy. And that's essentially all but what we did. Now, of course, we've talked about this, that there were the essentials and non-essentials. I do want to make one case crystal clear. There's, in my opinion, tone deafness when it comes to this point of essentials and non-essential. You ask anybody today who doesn't have a job as a result of coronavirus if their job is essential, and they will tell you absolutely it is. Why? Because they provide some service, build some product, but more importantly, the essential part is they make money from doing what they do. They have a self-esteem that gets filled and they make money. So the idea of essential, non-essential, they're all essential. We just happen to be an industry that was deemed by that conversation, and I'm not sure was as empathetic as it could have been about how it would make people feel, that we were part of the essential. But the terrible deluge of data is underway now, and we'll continue and we'll update you a bit in more specifics here in a minute about that. We said from the very beginning that the road to recovery was going to be effectively three things. Of course, there's a lot of detail around the three, but three things were going to need to take place. First, we would need to see the Federal Reserve, who manages monetary policy in this country, step up, take action, arguably like never before. They benefited greatly by having the playbook left over from the Great Recession. Not that we wanted to use it this quickly, that is that playbook, but we did have it. And so they provided the lowest rates in history, now zero. Liquidity in almost every way. They are buying bonds, government bonds, they're buying mortgage-backed securities, they're buying municipal bonds, they're buying corporate bonds. They're buying almost everything and anything today to provide liquidity to the system. So from a monetary policy check, the road to recovery, we're on it. This is the whole process that the Fed has been in from the beginning has been to evaluate where there is the chance for them to use their tools. And I want to remind all of you that there's two mandates that the Fed has commonly focused on, and they will tell you that this is their job. Two mandates. One is to keep full employment, and the second one is to manage inflation in the economy. And keeping inflation at a moderate under 2% pace is key to having a stable long-term growth in the economy. One of the things that the central bankers, the Fed, is doing now is actually talking about potentially scrapping inflation and just using employment. Why? Because employment is going to be a big problem to manage, and they will use every tool in their toolbox to focus on that issue, and they should. So they will be not scrapping forever, but maybe for a considerable period of time, the idea that they're actually going to be focusing on inflation. The second thing we said is that the issue of Washington on fiscal policy, that they would really need to focus on making sure that those that are in need are getting dollars. So we passed a $2.5 trillion now stimulus package. There's been a series of them, but we're up to $2.5 trillion. I mean, we're talking about almost half the economy annually being thrown into the market. Now, it's not all in the hands of everyone yet, but it's working its way there. We've had direct unemployment benefit increases where they're paying more through the federal system to support those that file for unemployment, which is a good thing. People are making more money. It's in their pocket today so they can pay their bills. We also have the PPP, the payroll protection program, which is through employers. That was originally 350 of the 2.1 trillion. They increased it by 400 additional billion. So there are employers, small employers mostly, although there's some politically, there's some issues that took place with some public companies getting the money as well. But all it was a way for the government to give money to employers and tell them, look, if you'll keep all the people on your payroll, it's a forgivable loan. So it was a different way to compensate people so that we could minimize or mitigate the number of people that were going to wind up being in the unemployment lines. And what's happened is, if you go back to that slide for 1 second, thank you so much. If you go back, the biggest impact so far, is that the damage for wage earners has been at the lowest end, the service sector, and a byproduct, kind of benefit for housing, if you will, is that most of the folks in the initial phase, as bars, restaurants, a number of the service job sectors, they don't necessarily represent home buyers necessarily profile. It doesn't mean they're not important. They are essential, every single one of them, whether they lost their job because they were unessential or not. Of course they're essential, they're our neighbors, but they have been hit the hardest so far, the service level jobs, whether it's barbers or hairdressers, whatever, as I've already mentioned, bars and restaurants. So we've got work to do to help them. And again, Washington has been working on that the best way they know how. What's interesting is that the stock market has been pretty resilient through this process, which tells you a bit about where they think the economy's recovery is going to wind up going to, because to the extent that there is only a 16% reduction in stock prices from the time we started out. Of course, every stock's a little bit different, but 16% the overall market is down. That's not really consistent with the data, the economic data. And so it must tell us that, at least at this point, not that they're right, but that those that are market makers are believing that we're going to get a recovery that is better and faster, as opposed to some of the other types of recoveries. There's if you remember, the V-shaped, which is we go really down fast, which we are, and then we go really fast back up. So that's the one idea. There's the U-shape, which is we go down really fast and it stay down a little bit and then come back up, just a longer type of V, if you will. And then finally the L, where we go down and we flatten out and we don't come back up right away. So the stock market is telling us, at least at this point, that they are still predicting either a V, which is good, or a U, which is good as well. We'll take either one of those. Trust me when I tell you. The third idea about the road to recovery was coronavirus itself, that we just got to get better news on coronavirus. And of course, in the last week or two, the news we get related to coronavirus is mostly around the data, the number of new cases, we get the number of new deaths, and then we get anecdotally, we get a number of different data points, and we get a lot of talk about what's happening in terms of vaccine work, in terms of treatment work. Of course, the president will throw his 2 cents in about what he thinks could possibly be the home run or the Hail Mary pass. Not sure that that's his, well, I am sure that's not his area of expertise, but the reality of it is Dr. Birx, who I have great respect for, she also got really nice scarves. If y'all notice, I mean, she's got really nice scarves. I'd love to see her in the summer because I don't know what's going to happen with the scarf thing in the summer. But anyway, Dr. Birx says we need a breakthrough on testing. And so there's a number of different areas. Last night I watched 60 Minutes, and GM was making ventilators. And so they've changed their whole factory, or one of their factories concepts. So we got to get a breakthrough on a number of different fronts. Testing, we got to get vaccine. We've got to get some kind of antiviral or some type of treatment that actually shows that you could go out back to normal and that things would be okay. And, you know, one of the top doctors in the country who was really one of the pioneers on HIV treatment, he's very optimistic. In fact, he said science is going to solve this. It's going to come through. We're going to get there. And you want to believe that the brightest minds in the world are working on this right now. By the way, one of the reasons that, and this article will share it, that the belief is that the market is kind of rebounding is because there's so much work being done right now on a treatment. And so there are a number of drug makers, and those stocks are all, for the most part, moving higher because they are all marching together in their own separate direction with their own protocols and their own different ways of thinking about how we're going to solve this problem. But it's all science, and it's all moving with one motivation, obviously in mind, on the road to recovery, which is to solve that third issue, which is coronavirus itself. We need a permanent solution because the only way back to where we were prior to a self-induced economic coma that we put ourselves in, the only way to get back to that Goldilocks economy that we were in as of the beginning of March is to really kind of create an environment where we don't think people are going to go out and potentially get a virus that could potentially kill them. And that's obviously the deal. Of course, when we first got started with Corona, the big conversation, which encouraged us to go into a self-induced economic coma, shut the economy down, was flattening the curve. And the concept was, conceptually, if we stayed away from each other, we just stayed home for a while, it would slow the amount of new cases. That would keep the hospitals from getting overrun, and we wouldn't get rid of the disease. We would just defer it, stretch it out over time, flatten when it would actually take place. We need to do exactly the same thing, and I shared this last week, with employment, because the numbers are mounting. Of course, we have in fact lost 26,000, excuse me, million, that's an M, 26 million jobs. Now keep in mind, in America, there's 160 million people that are employed. So losing 26 million in what is essentially a 5-week period of time. And by the way, unemployment claims in America are filed on Thursdays, released on Thursdays, excuse me, they're filed during the course of the week. We released them on Thursday. So we did flatten the curve on unemployment, and unfortunately we're at a way too high a level. So we really need to be moving back down. The numbers, and again, when we started this, it was kind of like, hold on tight for the numbers. The White House advisory, if you go back to that previous one, thank you. One of the White House economic advisors, Kevin Hassett, has said that the unemployment rate is going to approach the rate of the Great Depression. Now, I say that it's going to be true, and I want to share with you the truth, always do. But I want you to hear it in terms and in context with the fact that we did this to ourselves. So we didn't somehow or another have an event like the housing crisis in 2007-8, where bad debt was the source of the heart attack that the economy had. This is one of those things, we actually shut it down. So the belief, optimism, the stock market, and some of the other indices that I've already shared is that we can turn it back on, reopen, if you will, get states moving back to work, and that the event will move back to normal. And so the numbers, get ready for them, because you're going to hear them in the news in the next 2 weeks. And in fact, next Friday is the unemployment number, May's unemployment for the month of April. It's going to be a very ugly number. There's estimates between 15 and 20% unemployment in America. And keep in mind, that number was 3.5% just in the beginning of March. So within a 2-month period of time, we would have gone from 3.5% unemployment in America to a number between 15 and 20%. So it's a big deal. That's why we got to flatten the curve on employment, because employment, if you think about a boat and you thought about a propeller on a boat, there's really two propellers on the economic boat that is the US economy. The one propeller, the most important one, is employment. That's cash flow coming through individual households and businesses, and in individual households going out and buying products and services and into a business, reinvesting back into business by hiring new people, et cetera, et cetera. The second propeller on that boat is debt. So individuals use debt to use for credit cards, for buying cars, for buying homes, of course. And then the government uses debt as a way to fund services that it can't pay for through its normal tax process. So the truth is there's two propellers. We need to get the employment propeller moving again. By the way, forget the political debate just for a minute. Forget what you think about the political debate, the essentials, non-essentials. The reality of it is that we simply have to get the economy working again, because the longer this event stays, the more permanent the unemployment becomes. The shorter it is, the less likely it's permanent, that is the employment. And we've got to turn employment around if we want to see the economy get back to business as usual and allow us to get out of it. And of course, we still have Corona to deal with. So we've got to hope science finds a pathway home. And obviously there's an awful lot of optimism that tells us that they're going to do just that. Let's move on now. Let's talk about housing. How about that? Let's get into a business that you and I know a bit about. So the driving housing, this is really important because it's a simple way to think about what makes housing better or not as good. First, demographics, right? That's the first thing, the number of people, because either people rent roofs or they own roofs. We want them to own roofs, and about 67% on average of Americans over the last 50 years have owned roofs. So the more people we have, the more people will need a roof either to rent or to own, and we want them to own roofs. And in order to do so, they have to have employment. That's right, we need jobs. So the second most important part of what drives housing is employment. And of course, I just gave you the not so good news as a result of a self-induced economic coma, which we hope we can then remedy and get ourselves out of. Finally, what drives housing is interest rates. So those three things. Good news about demographics. I want you all to hear this. Amazing. Okay. This is what the general US population demographics looks like. In the last 10 years, we've grown from having around 308 million people to 330. So that's good news. We're growing more households. Even better news for you and I. And by the way, do not complain about traffic. I'm not saying it's fun, but if you live in a city that's got a lot of traffic, that's because usually a lot of people are moving there. In Florida, 900 people per day in 2019 moved to Florida. And I don't think there's going to be a slowdown from people moving from the north, if you know what I mean, northeast particularly, to the south. I think we're just going to accelerate that. And by the way, 900 people a day. Georgia is getting 250 people a day, as is North Carolina. So the truth is demographics matter in housing, and so do where you live, because the demographics are more favorable in the South. We've told you that in the past. I just thought I'd give you the up close and personal look. And by the way, if I'm a seller in Florida, I'm a buyer in Florida of real estate. If you want to know, are we going to be okay in terms of values over time? Nobody can guarantee it, but these are the types of data points that drive demand. 900 people a day moving into Florida, 250 into Georgia and North Carolina, respectively. That, folks, okay, that drives demand for housing. Rent a roof, buy a roof. 67% actually buy roofs. So interest rates, the final point, we are at historical lows. And you look at a graph here since 1971, 50 years, and you can see we've been as high as 18% on 30-year fixed rate, and we've been down just below 4, which is where we kind of exist now, depending upon your credit score, which we're going to get to that here in just a minute. But the truth of the matter is that we are at generational lows. So demographics are extraordinarily favorable, particularly in Florida, Georgia, and North Carolina. Employment was, until we put ourselves in a coma. Hopefully we can get out of that now. And then interest rates are at historical lows. So the landscape when we started the year was never better for housing. If you were in our marketplaces, never better. And now we just have this major issue with employment that we need to figure out. And if we get that figured out, we're going to wind up recovering, which is, of course, what all of us want to do. Let's go to the Fannie Mae forecast. In fact, we talked about this last time, but I think it bears updating again. And again, these slides, by the way, all available. Tap on the email of one of your Supreme Lending loan officers, and we'll get you access to all this information. If you look at the top right where the red circle is, there were 6 million units sold in America last year. These are housing sales. This year, the number is scheduled to be 14% lower at 5.1. And then next year, it's going to go up to 5.8, 14% higher. So roughly right, the 2 years, 20, the one that we're in right now, and 21, the combination of those is going to be pretty good. In fact, we're in a quarter right now, the second quarter of 2020. This is the low point forecast-wise for the next 2 years. So we are living in that moment right now. Obviously, the self-induced coma kept people from buying. All the noise about employment spooked some people. We had some people lose jobs, get part of their income taken back. So there clearly is, this is the moment, the minute that we're in right now that is going to be the weakest, albeit that there are some good news, and we'll get to that in a few minutes, a little bit better than what we might have thought. But so we're going to be down about 30-some% in this quarter for housing sales. Next quarter, we see an improvement in housing sales, where we're actually going to see sales not down 35%, but more like 28%. And then the fourth quarter only down 16%. So to the extent that we're going to be getting better from this point forward, the expectation is that the self-induced coma will get undone, and we will slowly but surely get people going back to work, and housing will start picking up speed as we finish this year and certainly into next year. Every single quarter from the second quarter of this year through the end of 2021. So the next 6 quarters, third quarter of this year, fourth quarter, and then the next 4 quarters next year, each quarter has a double-digit improvement from the previous quarter. So we're going to be in a position where housing is going to get some wind behind it. We've had obviously a terrible northeasterner show up and hit us literally right square in the face in terms of housing in the second quarter, but we should see an improvement like we just reported that's going to take place. Fannie Mae is one of the best forecasters in the world. This is their baby, if you will, housing, and I've always seen them as one of the most accurate forecasters ever. So, and we are going to see interest rates, if you see at the bottom of the page, moving down as well. So we'll have the tailwind of all the stimulus that the federal government has put into the market. That's going to be behind us, pushing us. We'll have interest rates at their all-time low. And if that propeller starts turning again with employment, and we start getting back out of the coma and back working again, we're gonna wind up seeing the recovery take place. It doesn't mean it's not going to be messy and it's going to be perfect, but it certainly is better than where we've been living in the last 6 weeks. Let's move on then. I said there was a bit of good news, right? And there is. Zillow, well, I'm not saying you like them, maybe you do. But in either event, they report on our industry. Obviously, they're active in the business in a number of different ways, but they reported just recently that actually week by week, they're seeing demand, showings, viewings are recovering. And we got this information today with regard to home sales in the new homes business. And that is that we saw a low point the 1st of April, and now we're starting to see this pickup. And I believe that's a couple of things, and we'll get to new homes in a second, but I believe that the reason being is this conversation about reopening the economy has created a sense of optimism. Now, again, don't get caught in the political, oh, it's so stupid or it's so smart. The reality of it is that we cannot stay closed forever. At some level, we've got to get the propeller working again, get people back to work. Mental health is at risk. So is the ultimate depth of this economic abyss, if you will. So we have to do both. manage coronavirus smartly from a risk standpoint, health-wise, and we've got to get the economy back working again. And I believe as soon as we started talking about it, we felt like some people did, okay, this is the bottom. We're going to start making progress because jobs will probably get more stable, if that's even able to be said right now at this period. There's a second thing going on in the new homes business, which is this, is that there's a perception that they're not contaminated because they're new. And you can also go look at them. So to the extent that resales have a bit of a question, well, they don't necessarily. And then getting access because people live there, it's not as easy. As you all know, as realtors, it's more complex today to get anything done, a closing, whatever. We're still doing business, fortunately, but there are, of course, hurdles, if you will. Whereas in a new home, there's less hurdle. There's not a perception of any concern at the home from a health standpoint, and there's also no limits to getting access. Builders are dying for you to get access. So, but these are two anecdotes: total sales, Zillow reporting, and then new home sales. And we're seeing it as well. I want you to know Supreme Southeast is seeing a substantial, and I mean substantial, demand in terms of new credit pull, what we call credit pull, where we actually look at customers' credit on behalf of a referral from you, and thank you for those referrals. Please send more. But we have seen demand increase. We're at a 2-year high for demand for credit pulls, which is, and most of them are being pulled for the review of buying a home. So that tells me that we're penning up demand right now. There is demand, more demand than there is, in fact, contracts taking place today. So that speaks to Fannie Mae's forecast as acceleration would take place over the next couple of weeks. By the way, new home sales were down 85% after Corona first hit, and we went into this self-induced coma. As I said, we've improved 20% since then. So again, in keeping with Fannie Mae's forecasting, here we go. We're getting a little bit better, a little bit better, and a little bit better. And we would expect and hope and pray that we get continually better, as the forecast would suggest that it looks like we will as we go out through the second half of the year and into next year. Let's talk again now about housing finance and Supreme Southeast. I just want to give you a couple of updates that I think are worth you hearing. First of all, I've been talking over and over about forbearance. I'm telling you as a realtor, if a customer tells you, hey, should I do it? The answer is they need to get good counseling from their servicer. So have them talk to the servicer. We don't get in the middle of those conversations. We recommend you not as either. But I will tell you one thing, just so you know as a realtor, every time someone chooses forbearance, it tightens the next person's ability to get credit. Let me say that again. When someone files for forbearance and decides not to pay or renegotiate when they're going to pay, okay, which is what it is. It's not forgiveness. It's a renegotiation of when they will make their payments. The next consumer who tries to get credit, the noose tightens in terms of their ability to get credit. There are consequences to forbearance because it economically hurts the servicing industry of mortgages. And those investors, therefore, then are less likely to want to buy the next loan if it has any credit issues whatsoever. We've seen that play itself out in two areas. Jumbo financing is clearly been hurt. Now, it's only 5% of the total market, so it only impairs 5%. But the jumbo marketplace, there are far fewer investors than there were prior to coronavirus that are willing to even entertain buying a jumbo loan. And we've seen some of the biggest banks in the world pull out of jumbo loans. JP Morgan Chase notably just recently doing so. We've seen loan to value reductions where you could have gotten a loan with 10% down jumbo. Now it's 20 or 25. And the FICO score increases have taken place on jumbo financing as well. So the reality of it is we've seen that tighten, as I said, and it's all based on this forbearance issue, the perception and reality. There's now 5.5% of all the mortgages in America in 4 weeks. 5.5% of all the mortgages are now in forbearance. So it's a temporary state. It's another one of those comas or part of the coma, right? Because the economy, we put it to sleep. Some people lost their jobs. Then we said in the CARES Act, which was part of the stimulus plan, okay, you can negotiate with your lender and not pay for 3 months or 6 months or a year. The consequence of that is, as I just described, in the jumbo market, fewer investors, loan to value reductions, and FICO score increases. A second and major and concerning going forward issue is FICO scores themselves. So on an FHA loan, on a conventional loan, we've always had minimum FICO scores in our industry, right? Theoretically, there's not really a minimum on FHA, but there is in practical terms. And most people, lenders, would have thought that that was around 620. The practical, almost everyone now has moved to 640. And then reality of it is that some have moved all the way to 700 on their conventional financing. Wells Fargo, Bank of America both did that. In fact, Wells Fargo or Bank of America is only doing 20% down now. So that's not our situation, and it's not throughout the entire lender community, but it is a trend and it is a theme that has taken place because of the unemployment. We got to get the propeller to move again. We got to get the coma or the patient out of the coma, back working again. We do, because that will in fact ease some of the credit issues, because the propeller will start moving again, and forbearance will not continue to grow. It will, I guess we got to flatten the curve on forbearance now too, don't we? So we do. So anyway, that's where we're going. And I wanted to share with you that we, Supreme Southeast, look, the two things we want to do with you as our realtor community partners is this. We want to provide some sense of inspiration, and hopefully we do that from time to time to encourage you to be the best version of yourself. That's what we've always wanted to encourage the people that hang out with us to do, both at home and in the workplace, everywhere, all the time. The second thing we want to do is we want to educate. We want to put you in a position where, from a professional standpoint, your level of competence and representation with your customers is at the highest possible standard it can be. You could be the best professional you could be then. So that's what we want to do. Those two things, we make every attempt to do it. And what we've done now is we've gotten all of our CE classes. We're still working on Florida to get the CE classes approved in Florida to do by Zoom. But our fundamentals of credit, a continuing education class, our Market Like a Rockstar is up and running. So we can now do these for CE purposes. So for those that need CE and want to get a lot better professionally, we've got both, we got two great programs up and running via Zoom now. Credit, as we just talked about, is a big deal right now. The more you know, the better you are at home personally. And then also from a customer relation standpoint. And Market Like a Rockstar, listen, the guy who runs our marketing is a rock star. He used to be a rock star anyway. And reality of it is Ty does an amazing job normally training you how to be more effective as a professional marketeer. And we all need to be more effective. And in the day and time we're in today, Zooming, using the latest tools available to all of us, nobody better to teach this class. And so that's our value back to you. We feel like to the extent that we can help you as a partner get better at what you do, then we've actually acted in partnership. And we've also met our mission, serving others before ourselves. I mean, we look at you as our partners, and we want to do everything we can to support in any way we can, inspiring and educating you. Let me talk about the road to recovery in terms of our business. Look, if we're going to be down in sales in the second quarter, 30%, good news is the next 6 quarters, the second half of this year, and then next year, will get better every quarter. That said, we're still going to be below where we were in the first quarter of this year. So we can ill afford ever to lose a single customer opportunity to make somebody able to live the American dream. We can never do that. More importantly, right now, with business being down, you as an essential, also essential, you need to get paid. So we need to get every deal possible done. We created, with the conversation around FICO score being such a big deal now, we created a program called Credit Essentials for Home Buyers. We had our kickoff last Friday at noon. It'll be, at 1 o'clock. It'll be every Friday going forward at 1 o'clock. It's hosted by Lisa Myers. who's one of the top credit voices in the mortgage industry in the country, that is a part of the Supreme Lending family now. And we had 150 in attendance at our first meeting. These are home buyers who have credit scores, let's call it 615, 620. Well, you can't get a mortgage today unless we can get you to 640. Of course, we think we can. If you're at 640, you could be at 660 and then get lower cost. And if credit scores go higher, you'll get even you'll get that benefit of being able to buy. So if you look at our numbers in total, and I want to just give you a little bit of data on this because it's kind of a big deal. Last year, of all the 6,000 mortgages we did, purchase mortgages that we did, 24% of them were below 700. 24%, 1 out of 4 were below 700 credit score. 9.6%, 10%, roughly right, were under 660. And 7.3, listen closely, percent of all of the home sales last year that we were participants in providing financing were under 640. So today, the 7.3% wouldn't qualify unless you take your home buying potential customer, you get them with Supreme, we run their credit, we find out they're below 640, they attend our Friday home buyers class. We cannot guarantee them, of course, that they can get up, but we know roughly right on average that if people haven't done anything proactively to work on their credit, they can get 25 or 50 points relatively easy. And Lisa does an amazing job training it. Let me just show you the numbers. You need to understand this as a realtor. Listen closely. This is free. All you have to do is refer them to Supreme. We bring them to our meeting on Friday at 1 o'clock. We get them completely schooled generally on how one can improve their credit score. And then they can work through the Supreme LO with Lisa Myers to get an individual plan that will help them increase their credit score over a 30 or 60-day period while they're out looking for a home. That will keep them in a position where they can be a homeowner, they can buy so that they don't get knocked out if credit scores go a bit higher. And look at the chart here of cost savings. This is amazing. Let's say your customer has under 640 credit score, okay, which 7% of our customers last year did. And let's say we could get them to 661, okay? They save a point, 1% on a $250,000 loan. That's $2,500 we just saved them by going an hour or 30 minutes of class with Lisa, doing business with Supreme, letting us create that opportunity for the customer to improve their credit score. And all of a sudden they save a point. If they could get to 681, they save 2 points, which is 5,000. Oh, by the way, the little screen graph in the middle, not only do they save on the initial cost, but on their monthly private mortgage insurance. This is a 10% down conventional loan. If we get them from 660 to 700, their monthly mortgage insurance goes from 205 down to $100. That's $1,260 a year. So it's a couple thousand, $2,500 at closing, and then it's almost $1,300 a year over a 5-year period, which is the average length of how long someone would hold a mortgage. That's $7,500. Combine it to the upfront savings at closing, $2,500. That's $10,000. Not counting what they could save on their credit cards by their credit score going higher, customers, or by their auto loans by getting their, because everyone prices the same way as a mortgage company does, except the numbers are smaller. So listen, this is an amazing opportunity for you to be able to partner with Supreme, with your customers. And by the way, if they got a 700 credit score, which is pretty good, and we can get them to a 740, they can save $2,000, not $2,500. So there's savings here for everyone. It's Fridays at 1 o'clock. Kicked it off last week. We had 150 people. Amazing. We don't tape it because it's proprietary information to give away. And the Friday meeting is not to give an individual plan. They can ask questions, all your customers can, but it's not for an individual plan. It's to teach the principles of credit scoring. And then when we get the complete the program, if your LO in working with the customer, sends in a request. We'll do an individual Lisa will plan for your customers, because she can look at your individual credit and say, okay, here's what you specifically individually can do, the least amount of effort, the least amount of anything, and the most movement in terms of credit scores. So that's pretty much where we're at. I mean, listen, we're up and doing business. If you get a loan stuck at Bank of America or Wells or anywhere else for that matter, and you think we can help, we have the Supreme Rescue Service. If you've not used it, there's so many realtors that have, where they've called us and said, can you take a look? Give us a second look. We had a jumbo loan we just closed a week and a half ago where another lender couldn't do it. And we brought it in and got it done in 10 days. And I mean, we're talking about $1.5 million transaction that a realtor wound up getting paid. So pretty big deal. The Supreme Rescue Service, ask your LO about that. If you have a loan, either as a listing or if you're representing a buyer that needs to get handled. Hey, listen, every customer or company talks about being good in service. This is one of the top 5 most stressful experiences documented by anyone who measures stress that happens in people's lives, that is moving. Our service standards, a lot of people talk about service. Our service standards are second to none. Our top box, close on time, fund on time, every time. Our speed that we deliver to, and these things that we do, we are open to run transactions in 8 to 10 days. So the bottom line is that Supreme, our entire focus energy is to reduce stress, to eliminate the type of unnecessary stress that's associated with moving. And you cannot get rid of the moving itself stress, but what you can do is partner with professionals like our organization, who takes the time to see what's happening in the industry and then tailors its business plan so that we can fashion it around the needs of you and the needs of your consumer. And back to this credit scoring issue, it's a big deal. And we are really positioned right now to make a significant, and I mean significant, difference in the lives of your customers, so that they have a safe crossing, if you will, into home ownership, that beautiful opportunity that exists here in America, and separately that they get there with the least cost as possible, as credit scores wind up costing customers. And it's one of those very quiet costs. It's just the way we quote interest rates. When we see your score, that's the quote, higher or lower. And the reality of it is people could get their scores higher, in which case the quote will be lower. And that's, of course, good news. So that's it for our conversation today. I'm grateful that that we are getting closer to giving this patient a awakening. That is the self-induced coma patient, an awakening. Of course, politically, there's a lot of conversation about what's the right thing to do. What I think is that we, at this point, there are some conditions that have been created out of Washington for what data people should be looking at, states should be looking at in terms of opening. There's also this other condition, which is those that were considered non-essential, who had their businesses closed, or they had to go home because the business they work for isn't open. There's a lot of those, and you see it around the country. I hate that it turns into protests, but there's people that want to go back to work, and that's a natural thing. And to be honest with you, when I talk to people who don't want to see the economy open back up, I'm cool with that, because people have opinions, right? So there's a lot of news as to why you might not want to do that, but I haven't talked to one yet who was told to go home. The people that have been told to go home, they want to go back to work. And I'm not saying it's right. I'm just saying that's what's happening. We are going to slowly but surely start seeing states like Georgia put their toe back in the water, and hopefully, we get through it without a significant relapse, if you will. We got the curve flattened, or it feels like it's flattened in a lot of places right now. We need to keep it there if it's at all possible. That's it for today. If there's any questions, I'm happy to stay on for a minute or so and take those questions from whoever might have something that they want me to answer. If not, I just want to leave you with this. We all have choices to make, and we can spend all of our time worrying and being in angst about things that we have no control over, like coronavirus, and when is it going to end? When are we going to get the patient off of the coma and back working again? But I just encourage you, don't miss today. Don't miss the moment with the people that are closest to you, your loved ones that you're spending more time than ever with. Don't miss picking up the phone and calling somebody who can use a word of encouragement. Don't miss any opportunity to love your neighbor right now and be generous. And if you've got a job, and I do, and you do too, think about being additionally generous at this stage, because there are people out there that are in desperate need for somebody to show them a little love, both in terms of word and also in action. Ty, did you
one question that just came through in chat, and I realized that some folks may not know how to use the raise your hand feature. I will teach you how to do that if you take the Market Like a Rockstar CE class, and you'll be a Zoom rock star as well.
You will
be.
Yeah.
But a great question that came is, can any of their clients take the Credit Essentials class? Can the realtors out there refer any of their customers to come to those classes at Friday at 1 o'clock?
Yeah, they can. I would just say to you, kind of yes, because we're here to help. We don't want our competition coming on our calls for obvious reasons. It's a service that we have invested not only time, but talent and also treasure in. So we would hope that these would be Supreme lending customers, but someone's stuck someplace else and is trying to get their credit score higher, and you think that we could do some benefit by having them on our class on Friday, the answer is yes. If they need to take another step to get individual support afterwards, they'll need to go through a Supreme Lending Loan Officer to do so.
All right, well, let's wrap up.
Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.